Cool. Let's jump straight into it. So what is happening to earning rates? The crypto market's up, the overall market's up related to the macro picture. But what is happening to crypto rates in terms of the ability to earn a passive APY? We're going to jump into that. The recent boom in Ethereum, the recent boom in Bitcoin, all related, but the markets haven't reacted maybe as some would expect, including myself. So before we jump in, let's do a quick recap of why we're here, why we're doing this. But the main thing to pay attention to is this is a huge opportunity. This is a $100 billion overall market in terms of the lending market. It's a huge opportunity. And we think a lot of people have been left out, including people like myself who don't know all the technical terms, all the apps, services to use, and we want to build a simpler app to change that. And that's where Nook comes in, and we'll explain a little bit about that later. But first off, a few key things to remember is that this is a $40 billion market in terms of the lending value. The total value, again, is $100 billion. There's already 83 million people using this every day. And there's 30% plus APY returns that you can earn. So it's a huge way to earn passive income, alternatives to stocks, bonds, and other savings accounts. So we're going to take a look at two things, right? The bigger picture of the macro and what's going on in the crypto world, and then the smaller picture of like, how does this impact DeFi earning rates and what's the downstream effects? So quick recap of what's happening in the crypto markets. There's a lot of growth in the market again. So the market is up to $3.5 trillion in terms of total market cap, right? We've seen Ethereum make a resurgence. We've seen Bitcoin come back up, which is great to see. And another thing that we're quietly seeing behind the scenes that most people probably aren't seeing in the day-to-day news is that stable coins are really starting to kind of inflow and dominate. So $242 billion in stable coins. I'm sure this has now hit $250 billion, but it's really started to grow. And this is being led by a lot of institutional investors, which we'll dive into soon. But when we say institutional, we mean businesses, funds, ETFs, and governments. So I think this is a really interesting breakdown from River here, but institutions have come in and individuals have actually left in terms of ownership of Bitcoins. That change kind of indicates that businesses and large institutions are coming in, Blackstone, BlackRock, Fidelity, etc. But individuals who used to trade cryptocurrencies have maybe actually left or a bit more dormant in this bull run. So what is the impact on DeFi rates? How does that impact you in terms of passive income? If Bitcoin's at an all-time high and Ethereum's coming back up, shouldn't DeFi rates be booming? Well, kind of all depends. And we're going to break down kind of how that bigger influx into stable coins with institutions impacts the individual here with DeFi rates. So if we look at one of our favorite lending protocols, this is lending USDC on Moonwell on the base chain. The pink line here represents your rate and the blue line represents TVL. The pink line here has been pretty flat for the past couple of months, even though TVL has skyrocketed and returned to all-time highs. So what's going on here? Why is the pink line not super up and down in terms of the big spikes? Why is it not at 30%? That relates back to this influx of stablecoins and the supply and demand. So if a lot of money is finding safe harbor in stablecoins and in these lending protocols, more and more people are using it, the rates will actually be suppressed. And if individuals are not trading, and so they're not taking out loans and borrowing, the rates will remain relatively low. So we're starting to see that, or continuing to see that across Moonwell and lending protocols. We're seeing it across the board. In previous episodes, we've talked about how you can look at all the rates across different protocols on the base chain by supplying USDC. This shows the rates here. So 6.9%, 6.68%, all solid rates, but we're either seeing that you earn a solid 6 to 7%, or you have to go into liquidity pools to get the higher 20, 30, 40%. But that is a higher risk and a different kind of product. One thing I think to showcase here that puts in perspective is here are the chain fees and chain revenue for the base chain. And so you can see we've hit all-time highs in terms of TVL, but the base chain revenue, the chain fees are actually still lower than previous all-time highs. So what that's showing is that although there's a lot of money on the platform, not a ton of people are transacting on the platform in terms of trading altcoins and just trading assets. That means the lower demand for trade, more supply in terms of USDC. Again, supply and demand with borrow and trade means that you're not going to get a super high rate right now. Trade activity would have to increase. But in terms of hope, like there is still a lot of people using the base chain. So looks like we approached roughly 2 million active users, which is incredible. It just means that the people are there and the accounts are there, but maybe the trade activity is not quite there yet. So in order for things to turn around and to see really high rates, right, like 8, 10, 15% APY, we'd have to see traders start to borrow money and flip that kind of ratio on its head right now and drive up rates as supply kind of decreases. So quick recap, your principal is always safe. So even as rates go up and down, what I'm talking about really is your rates of return go up from 5% to 7% or 7% to 5%. It means your rate of return is going up and down, but your core principal is not. That's always safe. And the second main piece to take away is it's market-based, right? So lending pools depend on borrowing. So if more people are borrowing, that means it's harder to get cash. That means the lending rate will go up. But if more people are lending, including these new institutional investors that have entered the scene this bull run, the lending rates will go down or stay flat. And that's kind of what we're seeing. So returns around 6 to 7%, still quite solid, but it's not booming like it was a few months ago with 8, 9%. So we'll see if that sticks or we'll see if that changes over time. You can still earn 5 to 6% APY in the Moonwell app right now. That could always go up to 10%, 11% as we discussed. And we'll kind of transition into showing you how that works in the
Nook app.
Moonwell app.
Okay, cool. Now we're going to go into the Nook app to see how we can do it from the Nook app on an iPhone. If we open up the Nook app, you have two options. You can sign in or sign up. Let's hit continue to sign up. We break down the current savings rate, how you can earn in core and extra rewards, how it's safe by being collateralized, and how your Nook wallet's always yours. So the same premise of what we walked through on web with the Moonwell site, but a little bit more distilled down. Bear with me as I create a test account